Hello traders, the title of the video is a better way to use the average true range of Welly's Wilder like a pro. Alright, the better way to use the ATR or the average true range of Welly's Wilder like a pro. So traders know about the average true range. The first thing that should come into our mind when we are talking about the ATR is volatility, and volatility. Alright. Now, if we are using the average true range, we should only use the ATR on which time frame? On the daily chart, because the ATR is designed for a daily chart. Alright. So what we are about to discuss today is for a daily chart. So you may say to me, George, I'm a scalper, I'm a day trader. Why should I go to the daily chart? You look for a trading setup on a daily chart, and then you will switch to your lower time frame to trade it. The GSTW24 trader can look for a trading setup on a daily chart with the ATR, and then go to the first best time frame. So what we are about to discuss today is about a better way to use the average range of Welly's Wilder like a pro. So in a previous video, which I believe you have already watched, the title of the video is "A Technical Trader Reflects Upon the Average True Range of Welly's Wilder." Have you watched that video? If not, go and watch that video first before watching this one, alright? Technical Trader Reflects Upon the Average True Range of Welly's Wilder at 24 Stock Trader YouTube channel. DG2, DG4 Stock Trader YouTube channel. Check it out first, okay? So when we go to the daily chart using the average range, the first thing that we should do is to draw the peak of the average range. So I have on my chart here the average range. You see here, this is the average range. You want to quickly use your eye to spot the zone where the ATR is becoming overbought. Where is it? Okay, exhibiting the peak. So you can see here in the zone of for this particular instrument, the Canadian yen, the ATR on the daily chart is becoming overbought in the zone of 0.84. You have to understand that that level is only true, 0.84 is only true for that financial instrument. For another financial instrument, the peak or the overbought level of the ATR on the daily chart will be completely different. So the 0.84 is not a general level, like we say the RSI is overbought at 70. It's not the same thing. For every financial instrument, the ATR on the daily chart will have a specific, alright, related, okay, overbought level. You also have a specific related oversold level. So for the Canadian yen, the overbought level on the daily chart is 0.84. The oversold level, you see here, is turning around when it comes to the zone of 0.52. So just look at it, you see the range, just highlight the range of the ATR. So average, high, peak level, 0.84, average oversold zone, 0.52. After that, you will draw the median line between the overbought and oversold. So the median line for the Canadian dollar yen, the ATR on the daily chart is 0.68. Alright? Once you have finished to do that, how do you use the ATR in a better way? What we are trying to do, alright, is to find a high probability setup and be ready to buy and sell when the ATR is oversold. Did you get that? We are looking for high probability trading setup, alright, to buy or to sell when the ATR, the average range, is oversold. Why? Because the momentum, a strong momentum plus high volatility, alright, will often create, okay, a faster pace a price action. So you are likely to get paid very fast and generously if the ATR, okay, is oversold and it starts rising, so increase in the volatility plus the increase in the momentum will help your trade. So you say to me, George, I don't know what you are talking about today. Don't worry, okay? So here we have here, see the price from this top here. And now we have a double top. This is a very interesting double top. Why? Because the double top that we see like this, if the second top is formed of the price action going 1, 2, 3, the minimum price move is 3. You see, there was this top. Now we have 1, 2, 3 forming a double top. If the price found a resistance at that resistance level, all right, meaning that the common trend line here is kaput. Are you getting it now? The common trend line is kaput. That's a double top, isn't it? So we see that the price found a resistance. So there was a rejection of the price at the level of $91.33. Price returned back to the same level, and we see again a rejection, which means it found a resistance there. We want to use a different time frame trading method to sell it. Daily chart, hourly time frame, 10-minute time frame, or daily chart, first best time frame, TSTW24, or daily chart, and another lower time frame. So we are combining at least 2 time frame or even a 3 time frame, all right? So look, at the point where that high probability trading setup, this is a high probability trading setup because I understand this double top, this is a high probability, okay, bearish trading setup here on the daily chart. Look where the ATR is in the oversold zone below that 0.52. I'm talking about this zone. It was oversold. So we have a high probability trading setup. We are doing what we call a top-down trading method, and the ATR is low. If the momentum is start increasing and the volatility also is increasing, we are likely to see a faster, okay, pace price move. So which means the price is likely to go down very fast for bearish signal with a strong momentum and also with a strong, okay, volatility, because as the ATR is oversold, it's likely to start increasing. Remember that when it's oversold, it doesn't mean that definitely it will start increasing. Let me say this again. You see here, it was oversold. It started increasing, but it became oversold again. And it went up a bit and it came back. So when it's oversold, it doesn't mean that definitely it will start going up. The only thing that we can say is that when it's oversold, there's a high chance that it may increase. So if we have a high probability trading setup, plus a strong bullish momentum or bearish momentum at the time when the ATR, the average rate, is increasing, which means the volatility is increasing and the momentum is increasing, we are likely to get paid, okay, handsomely, so to speak. Which is, you enter the trade, if you are day trading, okay, 10 minutes later you get paid handsomely, all right? Or you are swing trading, all right, within 2 days you have already 200 pips or more or something like that. So strong volatility plus strong momentum, okay, plus a high probability trading setup is very good for day traders and swing traders. This is a better way to use, okay, the average true range of Welly's Wilder. All right. So another thing that I would say to traders, one can combine the oversold ATR with what? The double top and the double bottom chart pattern. One can also combine the oversold ATR with the price retesting a prior high or a prior low. So for instance, if the price is retesting a prior high and the volatility is low, the ATR is oversold, it's good for us in an uptrend. So if we receive a valid buy signal at the point when the price is retesting a prior high and we implement a top-down trading method, if the momentum is increasing, the bullish momentum is increasing, and the ATR that was oversold also start rising, strong volatility plus strong momentum with a high probability trading setup, meaning that we have a high chance, not guarantee, there is a high chance that we will get paid very fast and also handsomely. Now look at this example. So we're talking about this one here. The double top. You see how the price ran down very fast. Can you see that? During that time, the ATR went from oversold to overbought. Are you with me? All right. So the volatility was increasing, and also the momentum was increasing. See how the price ran down very fast on the daily chart. This is what you want to catch. So this is a better way to use the ATR. Normally, the ATR is used to set stop loss or to determine the volatility of the financial instrument that we are trading. But the only time frame that we should use the ATR on, normally, traders do use it on all sorts of time frame, but normally it should be what? The daily chart. All right, normally it should be the daily chart. You see here? That's what I'm talking about. This is a better way to use it. So again, so you want to highlight the peak of the ATR on which time frame? Daily chart. The low, which time frame? Daily chart. And you want to highlight the median line. Okay, so I'm talking to you about a better way to use the average to range of welder like a pro, combining high volatility with a high momentum with a high probability trading setup. So always, if you learn something new for the first time, all right, try to work with it, okay? Practice until you master it. Sometimes, this is a very important point. The ATR may be oversold, but it will not rise after that. You see here, it didn't rise straight away. So you may stay oversold for a long time. It may stay there, dragging its field, will not rise very. You see here, this says it went up a bit, stay below the median line. You see here. So don't think that whenever it is oversold, definitely it's going to go from the oversold to the overbought. But it's something that we can work with anytime we see a high probability setup and the ATR on the daily chart is also oversold. It's something that we can prepare ourselves for. And if the momentum, repeat, if, it doesn't mean that definitely will happen, but if the momentum is increasing at the same time like the volatility, we are likely to get paid handsomely. Handsome person. Handsomely. Am I speaking with my beautiful American accent today or not? So look here. One more time. You see, the ATR was oversold. Yes or no? Okay, this is what we are talking about. Do we have a high probability to setup here? Yes, there is one here. I'm talking about a double top and double bottom. These are high probability here. The price form at that point in time, a double bottom chart pattern. Stay with me, please. I want you to master it, and I want you to practice until you master it. So here it is. We have a double bottom chart pattern here. Do you see that? Price went now from a bullish chart pattern. Anytime a financial instrument goes up and form a bullish chart pattern after that, that bullish chart pattern is usually, I'm choosing my word carefully, is usually a high probability trading setup. On the other hand, if a price goes down from A to B, and after that it forms a bearish chart pattern, that bearish chart pattern usually is a high probability trading setup. Usually. I didn't say always, did I? No, I didn't. All right, thank you. All right, so this is high probability setup. So once this common certain line is kaput, we start implementing different time frame trading method. Or if you are using a TSTW24 day trading system, we go from the daily chart directly to which time frame? The first best time frame. Or if you know how to apply different time frame trading method or implement a different time frame trading method, the good news is that the ATR was oversold and we have a high probability trading setup. Does it mean that the ATR will start rising definitely? No. It's likely to rise. The volatility is likely to increase. So if the volatility is increasing and the momentum also is increasing, well, we are likely to get paid handsomely. Look here, price didn't go very far, isn't it? But you can see that this candlestick bar is quite tall, isn't it? This one is tall. Am I talking to myself? Is it tall enough for you? Is it tall enough? You see here? This is what we are now. Tall. Phew, one day, one candlestick bar. That's why you want to catch it. So you see the ATR was low, and we have a high probability setup, and the price start going down. So we can combine the oversold ATR, meaning that the volatility is low. So this is what the professional traders are doing. This is what the hedge funds are doing. So the hedge fund do not inter-trade because, if you are dealing with millions of dollars, all right, or billions of dollars, all right, or you are so rich. If you are so rich, donate to our website 24alien all right, or stochasticmoney.com, all right. Go and donate something today. Now, this to make you laugh a bit, all right. So if you are dealing with a lot of money in the financial market, do you go and buy a financial instrument when they are quite volatile? Volatile means it can go up, it can go down. So 1 minute is up, 1 minute is down, blah, 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 all over the place. It's all over the place, means volatile. You see, when you are boiling oil, you see how the oil jump up and down? It's what we call volatility. If you want to understand volatility, boil oil. The oil will jump even go into your face. Bah, 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 bah. It's a volatility. Jumping up, jumping down, blah, blah, blah. So the smart money, okay, does not buy or sell when the volatility is too high. They buy when the volatility is low. So they can work with the ATR when the ATR is low. So they buy when the volatility is low. When the crazy retailers are not there doing all kind of crazy things and messing on the market, they want it very quiet. So they place the trade in a low volatility period. And as the momentum is increasing and the volatility start going up, that's it. All right. They join the trend. All right. Now, when the volatility is high, or the ATR is high, the risk is high. As I explained to traders in the previous video that I have already mentioned that I will not talk about again, technical trader reflect upon the average range of well is well done. You see, I'm trying to remind you again one more time to watch that video. All right. When the ATR is going from the peak to the low, instead of the volatility is likely to go down. But I told traders in that video, which you promised me that you will watch today or after today, all right, when the volatility is going down from the peak to the low, from the peak to the midpoint, the volatility can be still high. It will start going down. The volatility will start getting down. If it start crossing the median line, heading to the oversold zone, sometime even from the midpoint to the oversold zone, the price can still be a little bit volatile, which means the volatility, the ATR may be lagging. This is what I say to traders all the time. The price is number one indicator. So you may notice sometimes that the volatility, the ATR is going down, while the price is volatile going up. Why? Because the ATR is lagging and the price is what? The number one technical indicator. Or it's just due to the characteristic of the financial instrument that you are trading. So sometimes the ATR may be struggling to catch up with some stocks that are gapping up, gapping down, running fast all over the place. So you may notice that the ATR is resetting itself because when it reaches the peak, it needs to reset itself. And when it's resetting itself, sometimes it will just drop down to the oversold. But the price may still be rising with a high volatility, which means the ATR is not catching up with the number one indicator, which is the price. All right, I don't want the video to be too long. I promise that I will keep this one short. Is 18 minutes too long? Yes, George, I want 5-minute video. I want 7-minute video. Don't worry. Next time, I'll record a very short tutorial for you specifically, okay? So this will conclude our discussion today about a better way to use the average range of well-is, well-down, like a pro. If you have any question or suggestion, please feel free to put in a comment section. I always read the comment, and in due course, I will be recording another video to answer your specific question. Before you run away, all right, if this video has been truly useful to you, or if it has opened your eyes, please let us know by giving us your beautiful thumbs up. If you think that, George, this is another rubbish, all right, be sure to mark it down. Don't go away without marking it down if you dislike it. However, if you think that it's an essential tutorial, you say, George, for the first time, I'm not very sure I should give you the thumbs up or thumbs down, but okay, I'll give you today, all right? All right. If you think it's an essential tutorial, okay, that can help other traders, feel free to share with your friend on Google+, on Twitter, and also on Facebook. By sharing it, I really appreciate traders who share our video because you are helping us, all right, by sharing it with your friend, all right? If you have not yet subscribed to our channel is 24 Stock Trader, digit 2, digit 4 Stock Trader. Subscribe today and be sure to click on the notification bell. Why? Because sometimes we are live streaming videos using YouTube Premiere. And when I'm live streaming pre-recorded video, usually I'm watching with traders if I have time myself. So you can ask me question as the video is playing, the live stream. All right? Until the next time, enjoy yourself and I'll be very happy. We are the TSTW24 traders talking about a better way to use the average range of Welly's Wilder like a pro. We are combining, the increase of the volatility when the volatility is low, plus the increase in the momentum, and also with a high probability trading setup. Happy to read to you all, and I will speak to you soon. Thank you for watching.